So 3 central bank decisions amongst the FX majors out of the way last week, and they were the heavyweights. Got ourselves 2 more amongst the majors this week, not to mention 2 amongst the emerging markets, key ones that definitely traders are going to be noting. Hello everyone, Monty here, market analyst at IGUE. And this time around, we're going to go and start off with a central bank rundown. We are going to go through the week ahead and recent economic data, all that fun stuff. We're going to go and start off with 7 central banks. In this case, we had the Fed last week. Not going to spend too much time here, but market pricing, courtesy of pricing in a final, by a majority, a final 25 basis point increase when it comes to July, but important, very important that they're going to be holding for the remainder of the year. So maybe not as hawkish as what dot plot, what the Fed officials were suggesting, but at the very least, that message coming through from the Fed officials where they were trying to push back prior to this, trying to push back against the market, saying that we don't see any rate cuts this year. We're going to have to hold higher for longer, and that's kind of what the markets are pricing in for the time being. What about the European Central Bank last Thursday? Rate hike 25 basis point as expected. There weren't really much in terms of surprises there, except when it comes to the revisions higher when it comes to pricing, lower when it comes to growth, and by a majority, markets are pricing there's going to be another 25 basis point rate hike when it comes to July. But beyond that, in terms of getting the deposit rate up to 4%, I think that's going to be the tricky situation and obviously going to be data dependent. So between now and then, plenty of items to process that could tilt it in one direction or another. Bank of Japan last Friday, thankfully, at least for those of you trading the bonds, thankfully no changes there. Yield curve control still in place, still at 50 BP for when it comes to the 10-year. So for the time being, that's kind of pushed out. Those that were hoping for any sort of change pushed out until July when they released their pricing forecast. We do get CPI later this week, which I'll discuss. But for the time being, on hold, and that's kind of a bit of a sigh of relief for those of you trading bonds. And People's Bank of China, that's going to be tomorrow morning. We did get, though, last week, the 10 basis point each rate cut when it comes to 7-day repo, as well as the medium-term lending facility, and that kind of opened the door and the expectation that, you know what, there's probably going to be a rate cut when it comes to the loan prime rate tomorrow morning. That's going to be Tuesday morning, that is. Tuesday morning, our time out here in Dubai. And of course, the 5-year, that's what the mortgages are based off of. So if they're really looking to help the housing market more, you might see a cut there, but don't be surprised if it happens as well when it comes to the 1 year. And I did speak before about the limit, the downside limit in terms of how much they can actually do easing out of the central bank, given the fact that they do have to note capital outflows. That's the reason why markets aren't just going to be looking at what the central bank does. They already have an idea now in terms of anticipating a rate cut, but also looking for some sort of bigger, say, fiscal stimulus package, sort of an overall package that can help get the data moving in the right direction, given it hasn't been as anticipated. The whole reopening didn't quite work out the way traders and investors were hoping. But on Thursday, we got ourselves 3, 2 of them amongst the majors. We got Swiss National Bank. They're expected to take it up by a majority, but though it's somewhat near the middle, that's going to be a 50 basis point increase, but fully pricing it is going to be a 25 basis point increase. So whether we get to 1.75 or 2% could make the Swiss franc a little bit volatile for those of you trading CHF pairs. The thing to note is that Swiss National Bank, the SNB, they have their policy every 3 months instead of every month or 6 weeks, like you see with most of the other central banks. So a lot of times it feels like, whenever they do meet, they got a bit of catching up to do, right? So that's when it comes to the SNB, and of course the Bank of England. Now CPI is going to be on Wednesday, and the expectation is that we're looking at, even if headline's going to drop to around 8.4%, the core is going to remain sticky at 6.8%. Long story short, markets are pricing in that there's going to be a rate hike, 25 basis point. But here's the thing: in the past, when markets would price in these sizable rate hikes, the Bank of England would try and push back against it and say, oh, no need to really go that high, or they're not anticipating that they're going to have to go that high. Are they really going to push back against what at times markets have been trying to price of a terminal peak rate of 6%? Are they going to push back against it, or no, it's just going to be a situation where, they'll have the rate increase, it'll be probably by split decision, right? There's always 1 or 2 consistent members that want to vote against, and leave it at that. So it'll be interesting to know how they approach, what type of hike this is going to be, even if it's just going to be 25 basis point and they don't go for what is very small minority pricing in a 50 basis point increase instead at the current Thursday meeting. And then we got the Central Bank of the Republic of Turkey. New governor, and the expectation is their key interest rate at least double. I know we've been hearing a lot of estimates. JP Morgan came out, I think, put out around 25%, Morgan Stanley 20%. They're putting in these huge amounts because of where inflation stands, roughly 40% versus what the interest rate is at, 8.5%. And the fact that they've got a lot, if this is indeed a policy U-turn, we're looking at sort of catching up and raising rates significantly within a very short period of time. Whether it gets to 25%, markets do price that eventually it's going to get to around 25% towards the end of the year, or whether they do so in this meeting or if you want to combine it with this meeting and the next one in July. But long story short, the fact that you've got targets all over the place, that just means that you could be in for some significant volatility. You're going to pull up IG's trading platform over here, and you can see that's USD TRY. So it's a dollar price against the Turkish lira. So as it's rising, it's a daily chart. You can see that ever since the end of May, start of June. It's been a big increase. That's after the political updates there in Turkey. So long story short, you could be looking at some really big volatile moves here just because of the expectation of where everyone thinks it's going to go. Or at the very least, central banks are going to have to step in the short term with what limited reserves they have to try and contain, at least briefly after the decision, try and contain some of that volatility. But that is something to note when it comes to those of you trading the Turkish lira, and that's going to be this Thursday. So let's go back and take a look at some of the recent data. I'm not going to delve too much in terms of CPI, nor producer prices that were released late last week, or even export and import trade pricing data. But long story short, this is, producer prices, 3 of the key items lighter than expected. Export and import prices, trade, all of them negative prints and all lighter than expected. Export prices down 10.1% year on year, negative 5.9%. These are definitely numbers that are moving in the right direction when it comes to easing price pressures. And I do like the fact that when it comes to U of M's, that these are preliminary figures, but the consumer inflation expectation, a 12-month drop for 12 months ahead, dropping from a revised lower 4.2% to 3.3%. I mentioned before that this was the one thing that the Fed didn't want to see when the previous readings were released before, where everything pretty much came down with the exception of consumer inflation expectations. I think the fact that it's dropped to 3.3%, the 5-year dropping a notch from 3.1 to 3%, that's kind of in line with what the Fed wants to see. And it doesn't hurt that consumer sentiment rose and bested estimates rising to almost 64. So I want to say a lot of this data was in the direction of what the Fed would want to see, and generally better than expected when it comes to retail sales was a beat. Month-on-month growth was 0.3%. Philly and New York or Empire manufacturing indices, both of them beat in the case of Philly still negative, but Empire emerging from contraction. The things that were amiss, industrial production, month-on-month down negative, down 0.2%, and the weekly claims, both initial claims worse than, i.e. higher than expected, as well as continuous claims rising to 1.775 million, though not really coming as a surprise, right? We know that at the end of the day, trying to control inflation, certain sacrifices are going to have to be made, and that's kind of the narrative that the Fed is kind of pushing towards. So this is all, I want to say, everything that we've seen roughly in line with what the Fed wants to see. And we did get some hawkish Fed speak from both Waller as well as Barkin, comfortable in terms of further rate hikes, basically pushing that narrative that, we still have, even if they don't end up doing it, but at least pushing that narrative, that tough talk that yeah, we're still in for another rate hike or two between now and the end of the chief amongst them is going to be Chairman Powell. He's going to be testifying on Wednesday and Thursday. Usually it's Wednesday. The first time he testifies, that's where you usually get a big movement, unless he says something very different on Thursday, which is unlikely. Then Wednesday is probably where you're going to get the significant movement. Preliminary PMIs on Friday globally, but for the U.S., and generally speaking, this is the theme, ongoing theme, I should say. Manufacturing weak, sub 50 readings, signifying contraction. Services above 50, signifying expansion. No changes there. And we got ourselves pricing data. UK CPI, I mentioned that's going to be the day before the Bank of England, and at the end of the day, Japanese CPI on Friday, where I want to point out that, when it comes to CPI, you've got the headline, and then you can hear about core, which is removing food and energy. But when it comes to Japan, core is removing just food, and then you have core is removing food and energy. So when they say the expectation is that, regardless of what happens with the headline, if core is expected to drop, that's core when you exclude food. If you exclude food and energy, core is expected to rise, and that's not something we want to see. And of course, that could influence the Bank of Japan's pricing forecasts, which are going to be released in their July meeting, which in turn, in the future, could go ahead and impact what they do in terms of monetary easing and whether or not they tweak their yield curve control program. I'm going to go ahead and just point out before I sign off here that we do have the weekly market report has been released. The link of this is in the description. It's got the week ahead. It's got plenty of other items, including, look, technical. It's got sentiment and technicals. I do want to point out, like when it comes to the pound and the Bank of England, sentiment and technicals have less relevance when it comes to significant and sizable fundamental events. But that being said, there are those of you that like to at least note the levels, whether they want to go with it, in other words, go with the move and go for a breakout strategy, or whether or not they want to go opposite, whether fade, reversal, or in the case of the pound, in this case under a bull average technical overview, via significant reversal for those of you that dare to go opposite. Plenty of other items here: USD, JPY, AUD, USD, gold, oil, and you got the 6 indices: Dow, S&P, Dow, Nasdaq, FTSE, ASX, DAX, and Bitcoin at the very end. So I want to thank you guys so much for joining us. Good luck out there this week, and happy ticks.